11 a.m., February 5th, 2026. Marcus is staring at his phone. His hand is shaking. Bitcoin, $61,000, down 23%. His portfolio, down $18,000 since yesterday morning. His wife just texted, "Are we okay?" His friend Jake just called, "Dude, I'm out. This is going to 50,000. Everyone's saying it. Don't be the last one holding the bag." On his screen, Twitter is exploding. Bitcoin breaking major support. Sell now or lose everything. This is 2022 all over again. His chest is tight. He can't breathe properly. Every refresh shows more red. 60,800. 60,500. The crypto fear and greed index just hit 5. 5 out of 100. The lowest reading since the FTX collapse. Lower than Terra Luna. Lower than the China mining ban. Lower than anything except the COVID crash. Marcus thinks, I need to protect what's left. His finger hovers over the sell button. $61,200. He clicks. Sell all. Order executed. The pain stops. Immediate relief floods his nervous system. He just locked in a 24% loss. $18,000 gone. But at least the bleeding stopped. At least he did something. At least he's safe. Cut to 7 hours later. Bitcoin $65,000. Marcus stares at the screen. He tells himself, it'll drop again. I'll buy back at 58,000 like the analyst said. Cut to February 12th. Today, Bitcoin, $66,700. Marcus hasn't bought back. He can't buy back higher than he sold. That would mean admitting he was wrong. He's paralyzed, watching the recovery without him. $18,000 in permanent losses, plus the gains he's missing. Now freeze this moment. Because while Marcus was selling at 61,000 in complete panic, while the fear index hit 5, while $3.2 billion in realized losses were being crystallized, something else was happening. Something Marcus didn't see. Something the panic was designed to hide. BlackRock's at Bitcoin ETF, recording $231 million in inflows on February 7th, just 2 days after the crash. Michael Saylor's strategy, buying 1,142 Bitcoin for $90 million between February 2nd and 8th, during the exact week Marcus was selling. Crypto whales moving 66,940 Bitcoin, worth $4.7 billion, into cold storage on February 6th, the day after the crash. While Marcus was experiencing the worst financial pain of his life, while the fear index was screaming, get out, while every headline was predicting $50,000, institutions were accumulating, whales were buying, systematic participants were executing their frameworks. If you're starting to see something deeply wrong with this picture, drop a comment right now. I see it, because what I'm about to show you will change how you view every market crash forever. And today, I'm going to show you the forensic evidence of the largest single-day wealth transfer in Bitcoin history, $3.2 billion, from Marcus to someone else, from emotional decision makers to systematic accumulators, from retail to institutions, all in 24 hours. And it all started 7 days ago, February 5th, 2026, 9:47 a.m. Eastern Time, the moment everything changed. But before we dive deeper, I want to see the footprint of this movement across the states, from the tech hubs in California to the trading floors in New York. I want to know exactly where you are in the world and when you're seeing this. Are you watching from a desk in Chicago or a home office in Austin? Drop your city and the exact local time in the comments right now. I want to map out where the diamonds are waking up. The wealth transfer happens across every time zone, from Eastern to Pacific. Let's show the scale of this systematic community from coast to coast. Your city, your time. Then let's look at what happened next. Let me rewind and show you how this was set up. February 4th, 2026, Bitcoin trading around $70,000, market relatively stable, fear and greed. Index at 26, neutral to slightly fearful, nothing extreme. Most retail investors like Marcus, comfortable, hopeful. Bitcoin had crashed from its October 2025 peak of 126,000, down 52%. Painful, yes, but the worst seemed over. Bitcoin was consolidating, finding support. Marcus had been holding through the decline, down but not panicking. It'll come back, he thought. It always does. Then something happened. February 5th, morning, Bitcoin begins declining. 68,000, 66,000. Nothing catastrophic yet. But the volume? Look at these volume bars from the data. This isn't gradual selling. This isn't slow profit taking. This is dumping. Massive sell orders flooding the market simultaneously. According to CoinGlass data, over $1.26 billion in leveraged long positions were liquidated on February 5th alone. Traders betting on Bitcoin going up had their positions forcibly closed by exchanges. Those forced liquidations became CL orders, which pushed the price down further. which triggered more liquidations, a cascade, a domino effect. Between 9 a.m. and 2 p.m. Eastern, Bitcoin collapsed from 68,000 to 60,100, 11.6% in 5 hours. But here's what makes this interesting. The narrative that appeared days later. On February 12th, 1 week after the crash, Standard Chartered Bank published their revised Bitcoin outlook. They lowered their year-end 2026 target from $150,000 to $100,000. But the headline wasn't the target revision. The headline was this quote: "In a worst-case scenario, Bitcoin could retest support at $50,000 before resuming its long-term uptrend." $50,000. Think about the psychological impact of that statement. Standard Chartered isn't some random crypto Twitter account. This is a $270 billion banking institution. They manage money for hedge funds, for family offices, for sovereign wealth funds. When they publish research suggesting a 40% further decline, markets react. And retail investors panic. Twitter exploded in real time on February 5th. Bitcoin going to 50,000. Standard Chartered never misses. Sell now or lose everything. The bull run is over. Fed hawkishness is killing crypto. Get out while you can. And the fear and greed index crashed from 26 to levels between 5 and 9, according to Alternative.me and confirmed by multiple sources, including CCN and CoinMarketCap. This was the lowest reading since the FTX collapse. Some trackers showed it hitting as low as 5, the same level as the COVID crash in March 2020. Here's what's fascinating about extreme fear below 12. Historically, it has coincided with market bottoms, not tops. COVID crash, March 2020. Fear index 8. Bitcoin at 3,800. 18 months later, 69,000. Approximately 1,700% return. China mining ban. May 2021. Fear index 10. Bitcoin at 28,000. 7 months later, 69,000. Approximately 146% return. FTX collapse, November 2022. Fear index 6. Bitcoin at 15,400. 21 months later, 73,000. Approximately 374% return. Every single time the fear index drops below 12, it marks a generational buying opportunity. Not a selling opportunity, a buying opportunity. But Marcus didn't know this. Marcus saw fear index at 5, Bitcoin down 23%. Standard Chartered, predicting 50,000, Twitter screaming panic, his portfolio bleeding, his wife asking if they're okay, and he sold at $61,200, and he wasn't alone. The Glassnode realized loss metric tells us exactly what happened. $3.2 billion in realized losses on February 5th. That's not paper losses. That's actual losses crystallized by investors who sold Bitcoin below their purchase price. Real money, real capitulation. To put this in perspective, FTX collapse, $2.8 billion over 3 days. Terra Luna. Implosion, $2.7 billion over a week. China mining ban, $1.9 billion over multiple days. February 5th, 2026, surpassed all of them in one day. $3.2 billion of Bitcoin transferred ownership, from sellers experiencing extreme fear to buyers willing to accumulate during maximum panic. If you've ever sold during extreme fear and regretted it, comment, "I've been Marcus." No judgment. We're analyzing a pattern here. But here's where this story gets really interesting. Because while Marcus and millions like him were selling, while $3.2 billion was being transferred, while the fear index hit 5, certain entities were doing something completely different. Let me show you who was on the other side of Marcus's trade. February 7th, 2 days after the crash. BlackRock's Bitcoin ETF, ticker IBIT, registered net inflows of $231 million, according to multiple sources tracking ETF flows, just 48 hours after the maximum panic, the week following February 5th. Bitcoin ETFs collectively showed signs of stabilization and renewed accumulation. After weeks of consistent outflows, the pattern reversed. And let me be very clear about the timing here. Bitcoin crashes on February 5th. Fear index hits 5, $3.2 billion in realized losses. Marcus sells at 61,000, and within days, institutional ETF flows begin turning positive. Major accumulation resumes. Fidelity's FBTC, similar pattern observed. After weeks of outflows, accumulation resumed in the days following the crash. Grayscale's GBTC, the consistent outflows that had persisted for months, stabilized to near zero by mid-February. Strategy, formerly MicroStrategy, Michael Saylor's company. Between February 2nd and 8th, Strategy acquired 1,142 Bitcoin, $90 million, average price, $78,815 per coin. During the exact week, Marcus was panic selling. On February 10th, Michael Saylor appeared on CNBC. When asked about concerns that Strategy might be forced to sell Bitcoin due to price declines, he stated, "That's an unfounded concern. We've got 50 years worth of dividends in Bitcoin. We've got 2.5 years worth of dividends just in cash on our balance sheet. We're not going to be selling. We're going to be buying Bitcoin. I expect we'll be buying Bitcoin every quarter forever." Every quarter forever, even if Bitcoin drops 90%. While Marcus was selling in fear at 61,000, Saylor was buying. But it gets even more interesting, the whale accumulation. According to Amber Data Analysis, on February 6th, the day after the crash, crypto whales accumulated 66,940 Bitcoin, worth approximately $4.7 billion. According to CryptoSlate, these whales moved this Bitcoin into cold storage, long-term holding addresses. While retail was panic selling, whales were moving billions into cold storage. This is the opposite of distribution. This is accumulation. And here's what makes this particularly fascinating: the recovery speed. February 5th, Bitcoin hits 60,100. Maximum fear, 3.2 billion in losses. February 6th, Bitcoin recovers to 65,000. February 10th, Bitcoin back at 68,000. February 12th, today, Bitcoin at 66,700. In 7 days, Bitcoin recovered most of the losses. The fear index climbed back to 12. The panic evaporated as quickly as it appeared, and the entities who accumulated at 60 to 65,000, already showing gains of 8 to 10%. Marcus, who sold at 61,000, permanent loss locked in, now paralyzed watching the recovery without him, unable to buy back higher than he sold, trapped by his own emotional decision. If you're starting to see a pattern in how wealth transfers during these events, hit that like button and comment. Wealth transfer. Let's see who's connecting the dots. But this raises a critical question. Is this pattern random, or does the data suggest something more systematic? And let me show you Standard Chartered's complete Bitcoin forecast history. Because once you see it, you can never unsee it. Standard Chartered's Bitcoin predictions. A complete history. March 2021. Bitcoin at $60,000, approaching all-time highs. Standard Chartered publishes Bitcoin to 100,000 by end of year. What happened? Bitcoin topped at 69,000 in November, then crashed to 35,000 by January 2022. They were bullish at the top. November 2022, Bitcoin at 15,500 after FTX collapse. The entire industry in complete fear. Celsius bankrupt. Voyager bankrupt. BlockFi bankrupt. Standard Chartered publishes Bitcoin faces further downside. Could test 12,000. What happened? 15,400 was the exact bottom. Never went lower. Rallied to 30,000 by April 2023. They were bearish at the bottom. December 2025, Bitcoin around 89,000 after hitting 103,000 peak. Standard Chartered, we're lowering our 2026 target from 300,000 to 150,000. They cut their forecast by 50%. What happened? Bitcoin consolidated. And according to ETF flow data, institutions continued accumulating. February 2026, Bitcoin at 67,000, down from 126,000 October peak. Standard Chartered, lowering year-end target to 100,000 from 150,000. Could drop to 50,000 before recovery. Notice the pattern? Forecasts become bearish after declines when fear is already elevated. Forecasts become bullish during rallies when optimism is building. One interpretation, they're simply reacting to market conditions with conservative analysis. Another interpretation worth considering, the timing of these forecasts creates conditions that benefit certain market participants. But here's what's critical to understand about market structure. Standard Chartered's primary clients aren't retail investors like Marcus. Their business model serves institutional custody services, prime brokerage for hedge funds, treasury management for family offices, investment banking for large corporations, structured products for high net worth individuals. When Standard Chartered publishes research, the question worth asking is, who comprises their target audience? Not retail participants on Twitter, their institutional client base. And what do institutional clients need most when deploying large amounts of capital into Bitcoin? They need liquidity, they need willing sellers, they need volume. They need market conditions that allow them to accumulate significant positions without driving prices up prematurely. So the hypothesis worth considering, does research that creates uncertainty serve the interests of institutional clients looking to accumulate? This isn't an accusation of impropriety. This is analysis of market mechanics. Research influences sentiment. Sentiment influences behavior. Behavior creates price action. Price action creates opportunities. And sophisticated participants understand this dynamic. Let me show you what the on-chain data reveals about who sold and who bought. According to Glassnode Analytics, the entities that sold on February 5th showed characteristics of short-term holders, coins held less than 155 days, wallets exhibiting loss aversion behavior patterns, leveraged traders forced into liquidation, transaction patterns. Consistent with retail trading behavior, Marcus's profile exactly. The entities that accumulated showed different characteristics: long-term holder wallet signatures, large institutional-sized transactions, addresses associated with known ETF custody providers, transaction patterns consistent with systematic accumulation strategies, Saylor's profile, BlackRock's profile, whale profiles. This represents what analysts call a transfer event. While Marcus was having the worst day of his financial life, someone else was having a very different experience. Let me introduce you to Victor, 7 a.m., February 5th. Victor checks Bitcoin price, 68,000. He doesn't feel anything. He opens his system dashboard. Fear and greed index, 26, neutral. Bitcoin price versus 200-day moving average, 18%, moderate deviation. Network fundamentals. Hash rate at all-time high ETF flows. Negative but stabilizing system status. Monitor. Prepare for accumulation if fear index drops below 12. Victor makes coffee. Goes to work. 9 a.m. His phone buzzes. Fear index alert dropped to 18. Bitcoin at 66,000. System. Threshold approaching. Maintain observation. Victor acknowledges the alert. Continues working. 10 a.m. Another alert. Fear index 14. Bitcoin at 62,500. System. Threshold approaching. Prepare capital deployment. Victor opens his trading account. Reviews his dry powder allocation. $25,000 reserved for extreme fear events. Ready to deploy. 11 a.m. The alert that changes everything. Fear index 5. Bitcoin 61,000. System triggers. Extreme fear threshold met. Execute accumulation protocol. Victor doesn't hesitate. Doesn't second guess. Doesn't check Twitter. Doesn't call his friends. Doesn't consult his wife. The system said buy, so he buys. Execution. 25% of allocated capital, 6,250 at 61,500, 25%, 6,250 at 60,825% reserved for lower if drop continues. 25% reserved as permanent dry powder, average cost basis, 61,150. Zero emotional involvement, zero fear, zero second guessing. The system triggered, he executed. That evening, Victor reviews the day. No celebration, no regret, no anxiety. He executed his systematic framework during extreme fear, identical to his approach during March 2020 COVID crash. November 2022, FTX collapse. Every other capitulation event. This is what his system is designed for. Today, February 12th. Bitcoin, $66,700. Victor's position, approximately 9% unrealized gain in 7 days. But more importantly, Victor's emotional state is completely neutral. Whether Bitcoin rallies to 80,000 or declines back to 60,000, his system will indicate the appropriate response. He doesn't need to predict. He doesn't need to hope. He doesn't need to feel. He executes based on data thresholds. Now compare Victor's experience to Marcus's. Marcus saw fear index at 5, panicked, checked Twitter, saw doom-called friend, got fear, felt chest pain, couldn't breathe. Sold at 61 pounds or $200, locked in 24% loss. Now paralyzed, watching recovery without him, total emotional destruction. Victor saw fear index at 5, executed protocol. Didn't check Twitter, didn't consult anyone. Felt nothing, bought at 61,150 average. Currently up 9%, completely neutral about next move. Zero emotional impact. Same market, same information, different systems, different outcomes. The difference between Marcus and Victor isn't intelligence access to information, capital size, education luck. The difference is the system. Marcus operates on emotion, social proof, headlines, fear. Victor operates on data thresholds, predefined criteria, systematic execution. And in markets designed to transfer wealth from emotional participants to systematic participants, that difference is everything. If you want to become Victor instead of remaining Marcus, comment, build the system. That's your commitment to systematic decision making. But here's what you need to understand. Victor's system isn't magic. It's not complicated. It doesn't require special access or millions in capital. Victor's system, the 7 principles. This isn't financial advice. This is analysis of how systematic participants approach volatility differently than emotional participants. Principle 1, never make decisions during extreme fear. Victor's rule is absolute. If fear index is below 12, I'm only allowed to buy or hold. Selling is not an option. Period. This removes decision fatigue and emotional override. The system decides. He executes. The historical pattern of recoveries is overwhelmingly clear. COVID crash, fear index 8 are right arrow dies. Bitcoin approximately plus 1,700% over 18 months. China ban, fear index 10, right arrow Bitcoin approximately plus 146% over 7 months. FTX collapse, fear index 6, right arrow Bitcoin approximately plus 374% over 21 months. February 2026, fear index 5, right arrow plus 11% recovery in 7 days. Extreme fear below 12 has preceded recoveries, not continued declines. The probability strongly favors accumulation over capitulation. Principle 2. Question the source. When Standard Chartered publishes Bitcoin could go to 50,000, Victor asks, who benefits from me believing this? They benefit through client liquidity, transaction revenue, and media attention. None align with retail success. Victor's framework, I observe their actions, not their words. Actions reveal truth. Standard Chartered said Bitcoin could go to 50,000. BlackRock's ETF did, accumulated $231 million 2 days after the crash. Michael Saylor said, we're buying every quarter forever. Strategy did, bought 1,142 BTC during the crash week. Principle 3, watch what institutions do. Victor tracks ETF flows, on-chain whale movements, and corporate treasury purchases daily. He monitors exchange balance changes and mining entity behavior using weekly data. These are actions. Actions reveal actual positioning. During the February 5th crash, words said, Bitcoin going to 50,000, sell everything. Actions, BlackRock accumulating $231 million within days. Strategy, buying 1,142 BTC, and whales moving $4.7 billion to cold storage. Victor follows the money, not the words. Principle 4, develop mechanical criteria. This is where most people fail. They have strategies, but not systems. System. When fear index drops below 12 and price falls below 200-day moving average, I deploy. Execution. Deploy 25% immediately and 25% more if price drops another 5%. Deploy 25% more if price drops another 10%, and reserve the final 25% as dry powder. Exit conditions. Fear index above 75 or price 100% plus above 200-day moving average. This framework removes emotion, decision fatigue, and second guessing. Principle 5. Accept volatility as the price of admission. Bitcoin dropped from 126,000 to 60,000. That is a 52% decline. Volatility is the feature that creates the opportunity. The pattern of 20 to 1,000, 200 to 69,000, and 126,000 is clear. Victor sees volatility as the mechanism that creates wealth transfer. Principle 6. Time horizon determines strategy. If you need this money in 6 months, you shouldn't be in Bitcoin, full stop. If your time horizon is 4 to 8 years, short-term volatility is irrelevant noise. Victor's time horizon is minimum 4 years, ideally 8 to 10. This allows him to weather cycles and accumulate during fear. Principle 7. Position sizing prevents catastrophic mistakes. Victor's sizing, Bitcoin is a maximum of 20% of the investment portfolio. Entry, dollar cost average over 6 to 12 months and maintain 25% dry powder. Leverage, 0. Ever, under any circumstances. This sizing means even a total loss to 0 wouldn't represent financial catastrophe. This removes the emotional intensity that drives panic selling. If you commit to building this systematic approach, comment system over emotion. 5%, those who studied the pattern, built the system, execute based on data, will accumulate and position for the next cycle. Which group will you be in? The market will reveal the answer based on what you do next. Will you build the system or keep reacting to headlines? Will you become Victor or remain Marcus? Next video. I'm examining the specific on-chain addresses that accumulated during February 5th, the institutional footprints, the accumulation patterns, the blockchain evidence of large-scale buying between 60 and 65,000, because the blockchain doesn't lie. Capital demonstrably flowed from emotional sellers to systematic accumulators, and I'll prove it with transparent data. I'm engineered markets. And remember, the market didn't determine who succeeded on February 5th. Marcus and Victor's frameworks determined outcomes. Standard Chartered provided the narrative. The fear index provided the signal. The transfer mechanism executed as designed. What framework will you execute next time? But before I go, I want to speak directly to you. If you're still watching this, you are already in the top 5%. Most people clicked away the moment I mentioned discipline or data. They wanted a moon signal or a get-rich-quick ticker symbol, but you stayed. You chose to understand the how and the why. That level of focus is the first indicator that you are moving from Marcus to Victor. You have the patience to study the mechanism before the next event. That is exactly what separates the liquidity from the accumulators. So I have a final mission for you to cement this mindset. If you're ready to stop being the yield for the big players, go to the comments right now and type, "I am the system." This tells me you've watched until the very last second. It tells me you're committed to the 4 to 8 year horizon. And it tells the algorithm that this systematic logic matters more than the noise. I'll be looking for those specific comments to engage with you. Build the system. Watch the data. Stay objective. I'll see you in the next breakdown of the February 5th on-chain footprints. Stay systematic.